Hi, this is Michael Jones, Chairman and CEO of Caravel Concepts. Welcome to Market Insights, our weekly commentary on financial markets and economic events. Let's get started. This week, we're going to talk about another hedge fund that blew up. Now, you may say, who cares that Archegos blew up? Another bunch of fat cat hedge fund managers and their fat cat customers lost tens of billions of dollars. So what serves them right? Well, normally I would probably take that attitude too, except this time when Archegos blew up, a bunch of banks also lost tens of billions of dollars. And what that revealed is that 12 years after Lehman Brothers and AIG collapsed, 12 years after we had the global financial crisis that made this huge, horrible global recession, it turns out that banks are still doing the exact same kind of transactions that they were doing back in 2008. And they are exposed to the exact same kinds of risks. And after tens of thousands of pages of bank regulation since then, you would have thought the regulators would have done something about this. But it turns out they haven't. So I think it's important that we understand the kind of transactions that banks have been doing, why they are dangerous, and how easy it would be for the regulators to stop this activity if they wanted to, and how only the regulators can stop it. Because the people working at the banks have a real incentive to keep playing the same game that cost the global economy so much 12 years ago. So, what are the trades that caused all the problems in 2008 and are caused the tens of billions of losses here in the last few weeks? Well, first of all, I'm going to give you the type of trade, not the specific trade, because the type of trade is called a derivative. Now, do not get panicky and think back to high school calculus. That is not the kind of derivative we're talking about. We're talking about a derivative that derives its value from something else. That's why it's called the derivative. Now, the specific types of derivatives that banks have gotten in trouble in the past, there's all kinds of different ones. Using derivatives to bet on subprime housing was a huge one back in 2008. But we're going to talk about a very simple type of derivative, because the principles and the concepts of the big, complicated types of derivatives that banks use all the time, you can understand with the simple contracts, and you can understand how the regulators could jump in and stop this kind of behavior. So, the simplest kind of derivative contract is called a futures. All right? And a futures, this is the simplest, this is the oldest type of derivative contract. The Code of Hammurabi, which is almost 4,000 years old, had laws regulating futures trading in agricultural commodities, believe it or not. So human beings have been doing this for almost as long as we could read and write. And so don't think you can't understand this, because you can. It's actually kind of simple on this basic futures level, because you can think about a farmer. He's growing wheat, and he wants to know what he can sell his wheat for. And yet the harvest is months in the future. And a baker needs to buy wheat, and he needs to know what the wheat is going to cost him, and yet the harvest is months in the future. So what a futures contract allows these two folks to do is it allows the farmer to say, I'll sell 100 bushels of wheat at $10 a bushel, and the baker can buy 100 bushels of wheat at $10, excuse me, not an acre, at $10 a bushel. and they both have locked in their cost for wheat. The baker knows how much it's going to cost. The farmer knows what he's going to get for his crop. This is fantastic. And of course, you don't just have to do this on wheat. You can do it on corn. You can do it on copper. You can do it on pork bellies, if you remember that Dan Aykroyd and Eddie Murphy movie, and orange futures. And you can do it on Microsoft stock and oil and almost anything in the world that you can imagine that people might want to trade back and forth. There's probably a futures contract on that item that can be bought and sold. All right, so this is how it works. Really simple, right? But there is a little problem. What if there's a drought and the farmer's crop fails and he can't deliver his 100 bushels of wheat? The baker's counting on being able to buy 100 bushels of wheat at $10 from the farmer. He has risk that the farmer doesn't live up to the deal. And similarly, what if the baker's a terrible baker and he goes out of business? The farmer's counting on him to buy his crop at $10. What if the baker can't fulfill his end of the deal? All right, that risk has been mitigated for the last 200 years by exchanges. The London Corn Exchange, the Chicago Board of Trade, there are exchanges all over the world. And what exchanges do is they stand in the middle between the farmer and the baker. And if anything happens to the farmer, the exchange makes sure that the baker gets to buy at $10. And if anything happens to the baker, they make sure that the farmer gets to sell at $10. And you're like, well, how can they possibly do that? And the answer is something called margin. And how margin works is pretty simple. The farmer who's going to sell, he's what's called short. You probably heard that term before. The baker who needs to buy, he is long. Now, if you are short, the risk is that prices go up and you don't deliver because you sold at $10 and this guy wants to buy at 10, not 12. Right? And so what happens is if prices on wheat go from 10 to 12, then the farmer is required by the exchange to post. They agreed to sell $1,000 worth of wheat. That wheat now costs $1,200. They have to post $200 in margin. Right? Similarly, the baker, since he is long, the risk on the baker is if prices go down. So he's agreed to buy $1,000 worth of wheat, and if prices go down on that wheat to $800, then he has to post margin of $200. Now, why does the margin take care of the risk? Because, and by the way, anybody who's an expert on futures contracts and the legal flow of funds and so forth, I'm going to give an example of how this works. This isn't the exact exchange of dollars and so forth, but the economic essence is that if the farmer can't deliver the wheat that the baker's counting on, and prices have gone up to $12, the baker has to buy wheat at $1,200, but he gets the margin, which lowers his net cost to $1,000. So he gets to essentially buy the wheat at $1,000 just like he contracted. If prices go down and the baker doesn't stand up to deliver, well, then the farmer only sells his wheat for $800. But he gets the margin, the $200, so the net, he gets $1,000 for his wheat. This is how margin protects the farmer and the baker. No matter who goes out of business, they're both protected. And of course, in the real world, it's not always a farmer who has wheat to sell and a baker who needs wheat. Sometimes this isn't a baker, it's a speculator. It's someone who just wants to bet that the price of wheat's going to go up. Or over on this side, it's not a farmer, it's a speculator who wants to bet that the price of wheat is going to go down. All right? And the thing is you don't care because the exchange is going to make sure you get your money, whether it's a speculator or a farmer. You're going to be able to execute on this trade. All right, now you're like, what does all this have to do with Archegos in 2008 and so forth? Well, You don't have to do these trades on an exchange. You can go straight to a bank and say, I want to bet that Microsoft stock is going to go up, or I want to bet that oil is going to go down, or I want to bet that a whole bunch of subprime homeowners are not going to pay their mortgage. You can structure all kinds of what are called over-the-counter contracts, derivative contracts. And in the case of this simple futures, if it's over-the-counter, they don't call it a future, they call it a forward. So you can go to the bank and you can do a forward contract. All right? And here's the trick. The bank has an option when they write that forward contract, because everyone's specific to the person they're working with. They can require you to post margin and be completely protected, or they can say, maybe we won't require margin. Now, this is really, really, really important, because I'm going to go back to that movie, Trading Places. And you remember when Dan Aykroyd is holding Eddie Murphy because they're so excited because they made so much money, and they turn to the Dukes and they say, you need to post margin. It's the end of the trading day, you got to come up with the money. And the Dukes didn't have the money. And when you didn't have the money, the exchange can go and sell their business and their homes and take everything that they have so that they can make sure that everybody's protected. Now, what if you do a forward contract that doesn't have that requirement? What if you don't have this margin that protects you? Well, in that case, what happens is that the bank takes the loss. The bank is taking the risk that the hedge fund or whomever it is that they're trading with won't make good on the contract. And of course, in the case of Archegos did not make good on their contracts, and a lot of banks lost tens of billions of dollars because of that. Now, why would banks want to do that? Well, because remember, the exchanges make no exception. They don't care who you are. You can be the richest billionaire in the world. You can be Jeff Bezos, and you're still going to have to post margin if you try and do a trade at the Chicago Board of Trade. But on a forward transaction, the bank gets to decide who does and doesn't post margin. And a hedge fund can go to a bank and say, well, wait a minute. If you're going to make me go post margin, maybe I'll just go and do my trade at some other bank. You see that there's a competitive nature, because the hedge fund doesn't want to post margin, because every time they post margin, that takes some of their capital and it limits how big a trade, how big a bet they can make. By banks not requiring the hedge fund to post margin, they let the hedge funds make bigger and bigger and bigger bets. And so when they blow up, it's more spectacular. So, boiling this all down to, the problem is that in 2008, we discovered that when banks do these over-the-counter derivative trades, they don't just always hold on to them. They might trade it off, they trade them back and forth, they spin them all over from bank to bank to bank to bank. And essentially these over-the-counter derivative contracts become like rope that are tying all the banks together, and the banks become like mountain climbers. If one of them falls off the mountain, it can pull all the other banks down with them, because these over-the-counter derivative contracts are the rope that tie them all together. And that's what we saw happen in 2008. And what we know now with the Archegos failure is that they're still tied together. They're still doing over-the-counter derivative trades, and some banks are not requiring margin. And we need to be clear, it's only some. There were some banks that got all their money back, and there were a lot of banks that did not. But the point is that these banks get bailed out by governments when they fail. This isn't their money they're betting with. They shouldn't be allowed to do this. And you say, well, why doesn't the management of the bank stop it? Because think about what happens when you do an unmargined derivative. Because it's really valuable to the hedge fund to be able to do that, you can charge them extra. You can make more money on that trade. So you make bigger quarterly profits as long as the hedge fund doesn't blow up. You get bigger bonuses. Instead of making $5 million, you might make $10 million in your quarterly bonus check. You see the incentive to do these unmargined forward transactions because they make more money on them. And what happens if the hedge fund blows up? The trader who gets the big bonuses, they don't lose any money. And in some instances, the bank doesn't even fail. It gets bailed out by the government. So all the incentives in the private sector are to do these unmargined derivative transactions. And the only people that can step in and stop it are the regulators. And how hard would it be? I mean, they did 10,000 pages of regulations and they missed the point. The point is, if you do a derivative contract, you're a bank that might have to be bailed out by the taxpayers, you have to post margin. You have to get margin on that transaction. Period. End of statement. It could be a paragraph or two and it could solve the problem. Thanks for joining us for Market Insights. We hope you found it informative. If you did, please like our video and share it with your friends. And you can also check out our other research at our website, caravelconcepts.com, or by subscribing at the link below. Thanks.